Hey all, welcome back to another episode of Insight. Dhruv and I are thrilled to continue bringing you stories of inspiring professionals from the Indian slash South Asian community who have made their mark across various industries. Our goal is to give you insights from those who have reached incredible heights in their careers and hopefully inspire you to carve your own path towards success. Today, we have a special guest, Mr. Sinha, joining us. Mr. Sinha is a partner at Ares Capital Management, where he plays an important role in shaping investment strategy and works currently as a quantitative researcher and a partner, of course. Prior to this, he'd served in several leadership roles at several different prestigious firms, including director and manager at JP Morgan. And we're excited to hear more about his journey and the valuable lessons he's learned along the way. So, Amit, welcome to the show. So, I guess to start
Thanks
off,
for having me.
of course. So I guess to start off with our first question and sort of build a conversation from there, um, from our prior knowledge, quantitative strategies have long been dominant in public markets, but private markets have traditionally relied more on fundamental analysis. So, how do you see the role of quantitative research evolving in these private markets, especially at a firm at Ares Management or generally the market trend overall?
Absolutely. So firstly, great to be on this podcast. And one quick housekeeping note, anything that I do say today are my own personal views and not necessarily that of Aries. But hopefully a lot of them will align. So firstly, I think that's a really, really good question, guys, because you're right. There's a lot of in public markets, there's a lot of quantitative finance, a lot of quantitative hedge funds, investments, etc. Private markets have typically tended to be, whether it's private equity, where you're investing in companies, or private credit, where you're lending money directly to companies at a high level. Typically, the way people analyze companies is from a very bottom-up approach, fundamental analysis, like you pointed out. But increasingly, you're seeing a lot more use of quantitative tools and techniques in two areas. The first is at the start, like how a analyst identifies good opportunities, right, to invest in. And then also on the second side, which is more interesting to like the investors in these funds, which is how do all of these different investments come together? And what I might do is just spend a couple of minutes just going deeper into those two to just explain what I mean, right? So fundamentally or philosophically, whether it's public markets, private markets, any investment is an exercise in making predictions about the future, right? So you can think about it, if you use a mathematical term, probabilistic expectations of the future, right? So there's nothing certain. So the greater certainty you can get, or the greater you can increase your odds of success, the better you become as an investor over time. And so if you take that philosophy and you go into private markets, let's take the two examples I gave you, the scale, right? So in scale, that's really trying to help make investment decisions at the individual deal level at a faster pace. So let's say you've got a good model or a good fundamental insight, but if you're going to do it one company at a time, your scope is limited. So some of the work that we do is working with various investment teams in saying, okay, you've got a really good idea. Can we use quantitative techniques to test that across 100, 200, 500, 1,000 different companies, right? And so in the time that it would have taken you to do maybe 100 discounted cash flow models, to use an example, can you do 1,000? Can you do 10,000? And so that's one, which is scale. The second, that's what we call portfolio construction, right? Where if you're making one investment, you're very focused on how that investment works. But how does that invest, if you combine that investment with 5, 10, 15 other investments, what happens, right? And so typically you might have heard about diversification, where you don't want to have all your bets. So there might be 10 investments, all of them might have really good returns on paper, but they're all, let's say, correlated to the price of oil. That may not be a good investment, right? So you can use quantitative techniques to say, let me build a portfolio of private assets where some might have exposure to inflation, some might have exposure to growth, some may actually, if the markets are doing badly, these investments will do well. So those are the two areas where you're beginning to see quantitative techniques, quantitative research, helping make better decisions in private markets.
Yeah, that's very insightful. I mean, I think, do you think that in terms of this, using these quantitative tools and mechanics, of course, a lot of people do pursue, I've seen a lot of people, at least a lot of my acquaintances have gone to university to study specifically, quantitative economics is a pretty common major, I would say. And I see a lot of people pursuing that. Do you think that, like, thinking from a background perspective, do you think that a major like that is super beneficial to become a quant researcher, or to be involved and be have a very good and solid understanding of these of different quantitative models, or do you think that this is something that can be learned individually, for example?
So, look, I think both work, right? Definitely being in having in economics, finance, I'd say even math, and more computer science, like having these type of disciplines definitely help. But one of the biggest, like again, I'll start philosophical and then I'll get into more practical application. Philosophically, if you think about quantitative finance, it's really about pattern recognition. So it's understanding how there are relationships, understanding how you can take raw data, which might look very ugly and messy, and figure out how to make investment decisions from that. How do you interact between a lot of human beings? Because ultimately, investment decisions are in the end made by people. People have their biases, motivations, all of that. So that makes, and what I personally find interesting about it is that that makes it a very multidisciplinary function. So I've seen people in my experience with many different backgrounds, right? Including me. Like, so for example, there's someone I know who's very senior at one of the quant hedge funds. He had a PhD in philosophy. There are people on our team with backgrounds from, there's somebody who actually used to do comparative religion. There's someone who used to do protein folding, biomedical engineering. And so you have these different disciplines who somehow make their way into finance. So um, while it helps having the academic background, and what's probably more important is having that mindset, that ability to recognize patterns, the ability to do that extra work, learning what you don't know. Like for example, and he's actually doing some really cool machine learning work in the credit markets on our team. And a couple of years ago, he was working on a PhD in biology, like protein folding and things like that, right? But over the last 2 years, not only has he learned the technical aspects like machine learning tools, etc., but also the business side where he's been working with the investment teams to learn how credit decisions will get made.
Okay, yeah, that's very insightful, and I'll hand that torch off to Drew to continue us on.
Yeah, I mean, I personally find that very interesting because our guest last week, Mr. Tiagi, who also works in a similar position to you, he actually came from a computer science background, and he was saying the same thing where you don't have to take the traditional route to get into a high finance job. So I found that very interesting. But more generally on the topic of quantitative finance, how have you seen different firms such as J.P. Morgan or Ares Management, uh, you know, progressively use quantitative research more and more, especially as technology has developed over the past 20, 30 years?
Sure. So maybe what I'll do is I'll use my personal experience as the arc over time because fortunately or unfortunately I've been in this industry 25 years. So um, so when I started out in fixed income derivatives at JP Morgan. And derivative instruments, for those who may not be familiar, are um, these contracts or investments whose value is derived from something else. Okay. So that was a relatively technical field. Um, at that time, you saw most of quantitative finance at investment banks. A lot of work was done in what you would call fixed income, right? So, uh, for example, one of the simplest things that everybody or most families use is a mortgage, right? So, you, or in your case, your parents, if they're going to go and buy a house, most likely they'll go to a bank and borrow money as a mortgage. That is the reason individuals can borrow at the rates they can, which is relatively low, for the time period they can, which is over 30 years, is actually a result of a lot of quantitative finance work that happened at banks during, I'd say, literally the growth was probably in the 70s and 80s, mainly because of basically these quants figuring out how to take the risks that a bank has when they make these loans and package those risks into these various instruments that different investors can buy. So somebody who wants to take on more risk can take one investment. Somebody who wants to take another risk can take another. And this created this mortgage market, companies like Fannie Mae, Freddie Mac, which you guys can probably research later, or your audience can. And that was the start, right, of quantitative finance in the banking world. Similarly, in the hedge fund world or the investment world, you had people like Ed Thorpe who figured out that you could, or like Bob Merton, who won the Nobel Prize for options theory, who figured out how you could actually come up with these formulas or equations to explain a lot of what happens in markets. So that was sort of the start, right? Which was a lot of these like packaging of risks or understanding risks. Over time, what you've seen evolve, and then is as you're getting more data, you are seeing like three or four different areas. So if you look at the world of traditional investment banks and banks, there's a lot more risk management that's happening, right? So understanding, okay, we've got these millions and millions of different positions. If the financial crisis of '08 happens again, what do we do? Right. So that's one area. With a lot more availability of data, a lot more predictive analytics have become possible. Like in the world of consumer finance, being able to predict consumer loans and defaults and things like that, or who's more likely to take on what certain kind of loans. That's become an interesting area. In the world of investing, which is closer to what I'm doing now, you've got quant making its way into a bunch of areas, right? So one is on the trading side. You've probably heard of high frequency trading and those kind of aspects. In the more what I'd call portfolio or long-term investing, right? Which is you typically have these pension funds, endowments, insurance companies that have a longer term horizon and they're trying to figure out, okay, how do I best allocate my capital to earn returns? So in that world, what's really interesting is quant is evolving. Earlier, you had a lot of theory, like there's Harry Markowitz and his modern portfolio theory, which were built because you didn't have computational power. So you had to kind of make shortcuts, you had to make assumptions about how assets behave. Today, with additional data, you can actually go much deeper into some of those analytics. And I'll just leave you with one example in this question, and then we can go much deeper if you'd like. For example, let's say I've got a government bond, right, which is earning 4%. And that has very, very little risk because you think that if I give the US government money and I earn 4%, that's safe. The US government's not going to default, right? They're not going to not give my money back. But I don't want 4%. I want to maybe I'm going to make up a number, 12%. Yeah. So you might say that, oh, private equity, right, is a very good investment because historically we've seen private equity funds maybe earn about 12%. And so you say, okay, and so giving it to the US government, I'll give it to I'll give it, I'll put it into private equity. But you can do some more analysis and you'll see that while on average, private equity might have given you 12%. You've got some that have given you 25%, some that have given you zero. How do you determine or increase the odds that you avoid the zeros and you get towards the higher end? So these are the kinds of things that you can do with quantitative techniques, and with more data, more computational power, you can do this at scale.
So, I mean, kind of tying into that, sort of a follow-up question is, do you think that, I know you're a quantitative researcher, so maybe your answer will be a little bit biased to your profession, but how would do you think that when you said that, if I invest in private equity, I might get 25% return or 0% return? It's sort of, you can do it off of modeling and, data analysis. Do you think that you can predict, given how volatile the market is, especially in recent months, given current events, how do you think that like you can predict these kind of things using quantitative research, or is it an unpredictable market? Does it change? Could you give us a bit of insight onto that?
Sure. So I'll start with, and again, like, as I've been doing it, I like to first think about things in philosophy and framework and then come into specifics, right? So there's a very interesting subset of sciences, you could say, because it's physical systems as well as financial systems, called complexity science. And you might have heard of the term chaos theory. That's a part of this discipline. And a lot of what complexity science says is that there are complex systems like finances, like the financial markets is an example of that. And then there are many other natural systems like weather, where you it's almost impossible to predict. Yeah. But what you can do is just figure out what are the probabilities of outcomes, right? And you can try and improve your understanding of whether it's markets or investing so that you can increase the probability. So, like, if somebody comes to me and says, I think the S&P is going to go up 25% next year, I take that with a grain of salt, right? I say, that's a single point prediction. But if someone tells me that, with 51% likelihood of S&P being at 25% and a 10% likelihood that it's going to go negative 30%, and the negative 30% scenario involves these variables, that allows you to make a judgment about the future that's a lot more well informed. Yeah. And like, so there's someone called Dan Kahneman who, a Nobel Prize winning, uh, I guess you could call him an economist, though he did a lot more work in behavioral psychology. And so in his book, Thinking Fast and Slow, he gives this example of what's called informed intuition, where he did an experiment in the Israeli Defense Forces where, and I'll skip a lot of the details, but at a high level, they were interviewing people, and these were really qualified interviewers, right? And they were just using their intuition to make decisions. And the decisions, they'd have some good hires, some bad hires, etc. But then what they did was they asked the interviewers to ask some specific questions first, and then make a decision. And just getting that extra information from those questions allowed the interviewers to improve their decision making. And that's what I guess, the way I think about quantitative finance is it's all about increasing the probability and also recognizing what you as an investor can or cannot do, like where your constraints are.
Hmm.
Does that
Yeah,
answer your question?
I think that does a good job at answering at least my question, and I'm sure a lot of people.
Yeah.
You're giving some very good examples, so it's really great to hear, and especially from a professional in the field. So I guess kind of transitioning on a similar route, given the quantitative research and that kind of background, um, like with the increasing reliance on AI, and using AI across various different fields, as well as machine learning, which you briefly mentioned earlier, in the field of finance. Do you see this as an opportunity for better decision making or improving human productivity? Or, are there risks with over reliance on these algorithms and relying on AI to the limit of where people may even be losing their jobs in this field?
So that's a fantastic question. Obviously, very relevant. Um, so and I think there's a lot of complexity underneath the question that you're asking. So I'm going to try and unpack that a little, right? So philosophically, again, like if remember I spoke about Markowitz, right? And how that portfolio theory is that it's a balance. What you're what I think you're going to see is that the answer is going to be more of a balance of all of the things that you've spoken about. And the work that we, and by we, I mean the industry and the individuals in the industry need to do is really figuring out that balance. And the reason I say that is, um, look, my opinion is AI is here to stay, right? I mean, it's similar to whether it's the internet in the 2000s or like mobile in 2011, 2012 when high speed mobile came into play, plus the iPhone in 2007. You've seen these trends, and that's happening across industries, right? Not just finance. So, so to say that we shouldn't be using a tool is probably not the right answer. To say that we should be using these tools willy-nilly is also not the answer, right? So then it comes to finding that balance. And and where I think you're going to see that balance is going to come from a few different areas. The first is, and some of this, we're already seeing, like whether it's firms like Ares or other companies, you're seeing a lot of experimentation, right? Where we're starting with, okay, what are we doing today, and where do the new tools help us, right? Like if you use an analogy, let's say 30 years ago when the spreadsheet was invented, it might have been 40 years ago when the spreadsheet was invented. Before that, people might have been using pen and paper and calculators to do things, right? When a spreadsheet came about, people were thinking, okay, how do we use those spreadsheets? And today, you don't have someone asking the question, should we be using Microsoft Excel for this or not? And I think AI is somewhat like that, where you're trying to figure out how do you use this, and so then you look at what are the places where value is being added, right? And definitely data is one place. Um, Augmenting the analysis that an individual does is another example, right? Um, like one experiment we ran was, and I don't want to get into the nitty gritty of it, but just an example to illustrate it, is that, let's say you've got a process that you would be doing manually in Excel, right? And you'd be getting data from two or three different places, putting it together, and then after that, trying to understand what the results are. Now you've got tools that allow you to describe that process and then have that done over 100, 200 different companies using an LLM or using a bunch of tools. Maybe it's an LLM that goes and gets the data. Maybe it's a machine learning algorithm that then runs the data. Maybe there's an LLM that then looks at the insights in the data and then brings it back to a human to make that decision, right? So that's like one example of a workflow. And then obviously there's data protection, regulation, compliance, all of these added dimensions that you got to think about. But so when you put all of these pieces together, I think the key thing is going to be trying to understand where are the new tools helpful? Where can data help us make better decisions? Where can an LLM or a machine learning algorithm actually improve what we do by an order of magnitude? And then let's put together the right safeguards and controls so that we're not, it's going to be impossible to eliminate all risk, right? So it's really more to how do we make the risks more manageable and maybe well defined. And if something goes wrong, we know how to take care of it. So it's a very complex topic. It's emerging every single day, but I think that's the framework which, at least in my opinion, I see the industry will move towards.
Okay, yeah, thank you so much. It was really insightful.
Yeah, definitely not at the stage where AI can do everything, but I can definitely see the trajectory for it as it becomes more involved in the field. But on a different note, having grown up in India and later working in high stakes financial environments in the US, how have your cultural roots influenced your approach to problem solving and your take on leadership in the quantitative research world in the United States?
Sure, that's a good question. I'd say it's interesting, right? Like you have definitely your where you grew up, how you grew up, your background 100% influences who you are as a person, your personality, and all of that. Over the years, what I've figured out is there are lots of there are several things from that have helped you as a person, and there are several things that you might need to unlearn and learn new things and absorb new things, just in terms of behavior and personality as you take on different responsibilities and leadership, right? So I grew up in, like you said, I grew up in India, relatively, modest background, middle class background, good education, but it's at a high level, the big principles that I grew up with were, work hard. We don't have that much money, so if you want to do anything, you're going to have to be 10 times harder than anybody else because you don't have, you can only rely on the hard work that you have to get through. And that stayed with me, right? Like, so I tend to like putting in the extra work, knowing, going deep, understanding things, and that's helped me. But there have also been things that you learn when you're growing up in that background, like just focus only on your work. Don't speak up, right? Don't speak up unless you're 100% sure. And as you get more involved in, I'd say in general, the business world, um, a world where you need to take risks. Like if you look at in any profession, if you look at like the top 10% of people, somewhere in their life, they would have made one or two decisions which were against the odds, right? There are very few people who made it to the top of their game without taking risks, right? Without being fully certain of what it is they need to do. So that was one big thing I had to learn, which was that it's okay if I don't have 100% certainty on something, right? And and it's okay to take those chances, learn from that, and to speak up, right? It's okay to say, in my opinion, I think we should be doing this. In my opinion, I need to be given this chance to build this business. In my opinion, I know that XYZ is the way things are being done today, but I want to lead a team that's going to try and do something different, right? And you got to be able to take those chances. And I had to learn that over time because that was something that was different and uncomfortable for me coming from my background.
Yeah, I mean, I think that's very insightful, and it's pretty inspiring because I think me and Drew can both agree that although we are very privileged to not come from extremely modest, and that we only have our hard work to rely on, stuff that we're both extremely grateful for, we still get that same narrative pushed upon us that hard work, get your A's, be smart, you keep working hard. So I think that your story and the fact that taking risks, something that I feel like at least conventionally is not very pushed upon in an Indian household, where it's like, at least in India where I grew up for a majority of my life, it was like you have four or five professions to choose from. So I think that the fact that you have to take risks to become successful and I think that's something I completely agree with, and I think that's something that's very valuable for South Asians across the world. So I think on that note, it's a good place to stop. I mean, it's been an honor to have you here. You've come with some extremely valuable insights that I think not only are going to benefit the audience, but as well as me and Drew. We've learned a lot from from this brief podcast. So I think there's you to thank for that, and we really appreciate you taking out the time out of your busy schedule to come and speak with us today.
Happy to. I enjoyed it, and hope you guys have a good time, and wish you all the best.
All right, thank you so much, Mr. Sinha. Have a
Thank
nice
you.
rest of your day.
Thanks. You too, guys.
Bye bye.
Bye bye.
Yeah.